So I think the confidentialities are obviously a worry to people, but they can be solved and have been solved. And then it gives us some insights that we wouldn't otherwise have. If we just take a slice of the data, let's say on the 31st of December in 2009, at that time there were 317,000 people with stock positions. Someone out there owned at least one of the stocks. There were 19 of them that no one had bought, but there were 1,680 stocks listed in China at that time, and our investors own most of them. And it's a big data set. It's 53 billion of total holdings. So that's $8 billion. In the general scheme of data sets, this is a lot of holdings, and we're starting to get more representative. Not, it's not everyone. But what these data give us is it's almost like having a laboratory where we can test theories in finance. So we can follow single individuals up to 10 years, or we can cut the data at any point of time and look at the cross-section or both. We can aggregate up by area, gender. It's really quite nice, really fantastic, actually. What's also nice is to recreate this in a lab would be very expensive. So these are people that have 53 billion of real money on the line. Lab experiments are very nice, but if you're playing for 100 or 200 Hong Kong, it's hard to know, take from that, are they really playing with their own money? Are they just gambling? This is real money, it adds up. Here are the regions covered, the shaded ones. So there's at least one branch office in each of those regions. It turns out, though, you'll see later, most of the firm is heavily represented in the, so there's a red dot. It's not strong, there. It's not a very strong red dot. The firm's heavily centered in the Northeast, where it really began its brokerage operations, but it has spread out nationally through acquisition. And we have most of the regions, not all of them. There's some nice features of the Chinese equity markets from a researcher's point of view that makes doing studies in China actually better than studies, say, in Hong Kong or the US. The main issue in Hong Kong or the US is that you can buy stock in street name, basically anonymously trade. So that's great if you want to trade anonymously. It's very bad if you're a financial economist, because it's hard to know exactly who placed the order. Okay, when you work with a government that has a centrally controlled system, like China, what's nice is they like to track everything, and there's a lot of data out there. The Nordic countries have this. There's other countries that have some of these features. But one of the features is this rule that all of your trades go through the brokerage office where you open the account. So people open accounts near where they live, and regardless of the person, we don't have their address, but we do know they live near where they open their account, like 99.9 of them. You have to place the trades there. So that's one. The second feature that's especially nice is that China is such a diverse country. It has both ethnic groups and language groups. So it's one of these countries where we have one legal system, one set of rules, these markets, but we can look at how different language or ethnic groups behave rather than have to try to compare two markets, maybe in different time zones with different rules that may not be open at the same time. This is actually a great feature. The national ID cards, you can extract the birth, the region, the city, and the gender. And assuming people keep these up to date, it's fairly accurate, and the brokerage firm has done this for us. And then the other nice feature is China has 2 stock exchanges and no cross-listing. So you can actually look at effects of one versus the other, and there's not really a choice of, originally you were put on one exchange or the other. Now it's big companies, small companies. But their stock isn't trading anywhere else. All the trades for one company are taking place on Shanghai. There's no offshore trading, really. And so we get some nice identification here, which I can talk about later. OK, moving along. There's a list of behaviors and biases. I'm going to talk about 4 of them now. And then we, again, can talk about more. One is under diversification, which is huge for individuals. One is home bias, a preference for local stocks. This is very big in China, it's big in the US, it's big in most of the world. One is limited attention. This is a similar, it's a feature that's really more focused on individuals than any of the others. And then a couple notes on gender and trading. But here's our data set, and I'll go just a little slow on this slide. What I've listed is where the branch offices are located. Those are the 17 regions in the first column. The number of people we have in the data on this one date, on December 31st, 2009. It sums to the 317,000. And you can see that in Liaoning, that's the most. That's in the Northeast, and that's where the company started. But say in Hebei, we have 21,000 accounts. And Hebei's not the richest province, and you can see the average portfolio is 109,000 RMB. That's the average, but everything's skewed. The median portfolio is at only 26,000 RMB. Let's look at the bottom in Zhejiang, which is a rich province. The average portfolio is almost 1 million, and the median's 62,000. And so I think if you look across provinces and you look at the average, what someone holds, it correlates very highly with incomes or wealth. We have income data, and we've done this. The correlation's like 0.68. But no big surprise. People in rich province hold more stock. And it's nice to see the data reflects this. If we didn't see this, we'd be worried. The first feature I think we see is just that the median number of stocks that someone holds is very low. It's like 2 or 3. So when you go to buy stocks in China and you open up a brokerage account and you're only allowed 1 account in China, so there are other ways to save, but in terms of stocks, this is what the person has. It's 2 or 3. Interestingly enough, 2 or 3 seems to be the number around the world. U.S. investors, the typical U.S. retail investor at a small brokerage will also hold 2 or 3, but they may hold mutual funds and others off of their account. But it's very, very under-diversified, right? You're nowhere near your Markowitz efficient frontier with 2 stocks. You're not even in the ballpark. So I think that's the first thing to see. So again, these same numbers have been found in other countries, the Nordic countries, in the US. But now let's think about what's a takeaway. When investors in developed countries use the stock market to save for retirement, this is one mindset. So currently, like in Hong Kong, some people use it to save for retirement. We're going to see different behavior in this regard between China and Hong Kong. So there are many more stock-related products in Hong Kong or the US. People use them more. They save them, and they diversify across products a little better. And I think as we think about China maturing in the decade to come, it's going to be important for investors to transition into diversified portfolios. They're going to need to save for retirement, and you're not going to do it with 2 stocks. It's just not, it's not the way to do it. Like there's no world in which loading up all of your retirement savings in an undiversified portfolio makes any sense. So it just doesn't have any value. And I think as we move forward, or China moves forward, we'll see some changes in this regard. We may see people buying more mutual funds, or we may see ETFs or other products coming out to help them diversify. Okay. This under-diversification is fairly easy. The next behavior is called home bias, and it's this preference for local stocks. So what we can do is, for every investor, we can figure out the fraction of their portfolio that's invested in local stocks, or we can aggregate them in the region and figure out what fraction of all their wealth is in the local stocks. And then we can figure out how much of the market is from the same region. So again, imagine you live in Yunnan. How much of your portfolio, or you get all the people in Yunnan, are invested in Yunnan headquartered stocks, companies from Yunnan, versus how much of the market actually comes from that region. And then you take the difference of these 2 portfolio weights and call that home bias. If you bought the market portfolio, this measure would be 0. Just go think about it. You buy market cap weights, this would be 0. If you don't, and you have home bias, the measure will be positive. And sure enough, we see the far right-hand column, it's positive for every group of investors. Let's just look at Inner Mongolia, say Nemungu. Those people on average have 6% of their portfolio in stocks headquartered there. Almost none of the markets there, only 0.7%. So they're massively overweight local stocks by 5%. Now, you could say it's small, but if you look down the column, this is per person, it's kind of 5, 6, 7, up to 10% for Shanghai investors. We've seen this behavior. Now, this behavior is within country. This behavior was actually first noticed in the 90s across countries. People have been trying to figure out, Japanese investors own 90% of their wealth in Japanese stocks. US investors own 95% of their wealth in US stocks. Some countries, England I think is maybe, used to be one of the better ones, they still own 60 or 70% of their wealth in their home country stocks. China, okay, you have a reason Chinese people can't easily buy US stocks. So, okay, we'll cut them a break. But for other people, if you live in a small country, you're from Belgium or England's relatively small, it's got a big market, you would think that if you're just buying stocks and diversifying around your portfolio, you'd have to own stocks from around the world. Probably Finland's an even better example. Finland, what, you have 5 million people, you've got Nokia and a few other companies. I mean, if you're going to invest in stocks, it's almost impossible not to be thinking of the rest of the world. Yet Finns, like everyone else, have most of their money in Finnish stocks. So this is, and these are professional managers, they're individuals. This hits everyone. So home bias is this tendency to concentrate in local stocks. In China, we're looking at it intranationally, and it certainly adds to the under-diversification problems. You not only hold enough stocks, but you've concentrated too much of your wealth locally. We don't find any evidence. We've checked this. You could argue that people hold local stocks because they have better information, but we've checked and they don't do well on their local holdings. They don't do any better. In fact, a lot of them do worse. And in fact, home bias can affect prices of stocks. We can have a market impact because it doesn't spread risk efficiently. So if you think of an insurance example, if you're an insurance company in Sichuan province and everyone has to hold Sichuan risk and there's earthquake risk, you're going to get a higher price of insurance than if you can spread the risk throughout the country. Same holds for stocks. So we do see this a little. And like I said, this behavior has been found in professional mutual fund managers in a number of countries, US too. Okay, we have a couple more slides to go then. Back to Mr. Berry, who was thinking about how to purchase a stock. How do you do it? So how do individuals choose what stock to trade? So you could think of an individual with a very hard problem in front of them. It's like a hard calculus problem. They don't know where to start. So a lot of times they use a cue or a stimulus to kind of move this mass of stocks, in this case there's 1,680, from a kind of undifferentiated mass into a much smaller set that we'll call a consideration set. And it's of those stocks that they're going to think about trading. So in China, there's no short selling. So if you want to sell a stock, you have to own it. We know most people only own 2 or 3 stocks. So the problem about which stock to sell is really easy. You only have 2 or 3. You can't short any of the others. This is a simple problem. It's only the problem of which stock to buy. So let's suppose you're trying to think about which stock to buy, and now you see good and bad news about stocks. Okay, so 5 stocks kind of hit your radar screen, and you start thinking about this small set of 5 stocks. Well, you can't short the ones that you have bad outlooks on. You can only buy the ones you have good outlooks on. So we know that any stock that kind of ends up in someone's consideration set will ultimately be bought or not traded.